All right. So yes, I'm Ryan Daigle. I'm with Flywheel Equity, and I'm an operator here in North Carolina. I have a 20-year history in technology. I was an engineer, a CTO, engineering manager, blah, blah, blah. I've talked about it in some podcasts and stuff. I'm not going to spend too much time talking about my past because I really want to kind of talk about what I'm here to discuss today. This is a version of a talk, and you know what? I have slides, so I guess you would like to see them. Let's do this computer thing. There we go. Everybody can see, I'm assuming, my slides now.
Yep, good to go.
Yep, all right. So this is a version of a talk I've given a couple times now. So if you've seen this talk before, I'm like in the process of changing like the back half, the back 60%. So you've seen it before, stay with me through the front half, and the back half is a lot different than what I've talked about. So I'm kind of zeroing in on an idea here, and it's taking a few tries to kind of refine it, see what works and what doesn't. And this is really a talk that's for active and passive investors. It's really about kind of raising the underwriting game a little bit and how to look past the metrics I think catch our eye, which are the IRR, projected returns. Like those are the flashy metrics that, we as humans, we like simple things. We like one number to rule them all, and it tends to be IRR. And I kind of want to push against that orthodoxy a little bit and propose some alternatives. So this is what that talk is intended to do. So IRR is not your friend. How many times have you seen this in an OM? 15% IRR. I know I personally feel like every single OM I see, this is the projected return, right? And it's across operators and whatnot. And I even went out to the internet for those sponsors that kind of publicize their deals. I just captured a few, right? So we've got something in Fort Lauderdale here, 15%, 500 units. Columbia, Maryland, completely different part of the country, 15%. Austin, Texas, also 15%. Maybe it's that every really nice property gets 15%. Well, looked at some other operators. We got some, C, B class stuff here, also 15%, also 15%. So the conclusion, do you mean to tell me that all of those investments have the same probability of hitting that 15% IRR? No, I mean, they're in different metros. They're different types of assets. I'm sure they have wildly different rents, different tenant bases. There's so much that's different about each deal. But yet, if you're focusing on the IRR alone, and it's natural to do that as an investor, you're missing a lot of detail and nuance. And I think you have to realize too that, speaking as an operator myself, I know that when I'm looking at a deal and looking at projections and how I'm going to structure the deal and this and that, I'm tweaking the levers to try to get as close to 15% as possible, right? That's what we're all doing as operators, because we know that's kind of the minimum bar that investors expect. But some of the things we tweak are like very, very forward-looking numbers, right? An exit cap rate, the sale price 5, 7, 10 years down the line. I'm no economist. Even if I were an economist, I know I couldn't predict with any sort of accuracy those super high leverage numbers way down the line. Okay, so the IRR is really based on a bunch of forward-looking projections that nobody can know with any amount of certainty, with any amount of accuracy. And the truth is that really all your projections that you spend so much time coming up with through the due diligence process, through the underwriting process, the minute you take ownership of that property, all those numbers go out the window, right? Every property I've been a part of, that I've operated, that I've been an investor in, that I've talked to other operators about, your year one pro forma looks nothing like actuals. Your month one pro forma looks nothing like your actuals. Like the day you take ownership of that property, you've got variances all over the map, just all over the place. Now, this is not to say that planning is useless. It's just that plans are useless. Planning is everything. So it's still good that we go through the exercise of quantifying what we have as an investment. But I think we as operators need to educate investors, and investors themselves need to acknowledge how much variability there is in these types of investments and any investment. So not to get too caught up on just focusing on what the IRR of a particular OM talks about. To illustrate this concept, this is something that I pulled from my time in technology, but anybody who has a project management background will probably recognize what this is a graph of. This is called the cone of uncertainty. And it's basically just a visualization of, mapped over time, the amount of variability or risk or what you don't know mapped over time over the course of a project. So here at the 0 point on the x-axis is like the absolute start of a project. You're just beginning to define it. If we're talking about multifamily, it's like you've been sent an OM from a broker, or maybe it's an off-market deal and you've got a T12 and a rent roll in front of you, and you're just starting out. You're just figuring out the shape of this thing. That's when you know the least, right? You have the most minimal amount of information and you know the least. Go through, say you get the deal, say you own it for 5 years. The only point at which you have perfect knowledge is the day that about that as an investment is the day that you sell that asset, right? 5, 7, 10, whatever your hold time is in number of years. And like, if it were a project, it's the day that the project is delivered. So huge amount of variability on day one and minimal variability, minimal risk, absolute knowns on day X, whatever your endpoint is. So if we think about a multifamily project and this cone of uncertainty, there is such a huge amount of variance in your initial stage, right? If you look back over OMs or actuals from the last 10 years in the multifamily industry, most people have blown out projections to the upside, right? So this isn't just about negative variance. A lot of times it's to the upside, but that should still be just as alarming, because it just shows we have so little ability to predict the IRR, the actual returns. I can assure you, if the operators thought that they were going to get 40% IRR on that asset they bought in 2014, they either would have told you about that because that would have made the deal stronger, or more likely they would have adjusted the structure of the deal so that they got more of it and realistically showed you a 13 to 20% return, right? The fact is they were ignorant to it. So it works in both directions, but something that can go plus 20% on a 10% projection can also go to the other side. So it kind of proves the point. It's just that it's been good times for the last 10 years. So if we think about the lifespan of owning an asset, this blue line is like your day of close. You've gone through due diligence, you've done your underwriting, you've zeroed in what you think your budget's going to be. Maybe you've even gotten some quotes, right? You feel so locked in on day one of ownership, but it's still so early in the whole process. You have years of ownership ahead of you, of surprises, COVID, anybody, water main breaks, plumbing issues, rent expectations, not hitting projections, a bunch of stuff. And so you may think that you've accomplished so much to get to that day of close and you know so much. You know nothing. You still know nothing. Okay. So what's the solution here? Do we just throw up our hands because we're so ignorant of what the future might hold for us? Well, I think there are some other options. I think we need to use metrics that rely much more on what is knowable today and what is under our control, versus metrics that are dependent on super forward-looking timeframes, 5, 7, 10 years plus, or that are just completely out of our control, right? Like macro trends in areas, things like that whether we own a good asset, a bad asset, a good metro, a bad metro, macro trends are going to be affecting my property as much as it's going to be affecting your property in the same area, right? Like we just have no control over that particular outcome and what applies to us or not. So really focusing, I feel like the risk can really be mitigated if we focus on what we know today with as much certainty as possible, and what we, through our own ownership, what we're going to have the ability to determine the outcome of. So this is the knowable versus the speculative. Okay. What's an example of knowable things? Current rents, right, from the market, maybe not the exact property you're buying, but if you are going to upgrade your current property, it's a value add business plan. You can look at a comparable post reno property in your market, and that it's not perfect, but it is much more knowable than something 5, 7, 10 years from now, right? It's more of a very direct comp. You know what your initial financing, your interest rate, the loan structure is going to be. Your renovation budget. Trust me, budgets can absolutely vary, but you have the ability much more on day one to size out a renovation. Either you've done it before, you have vendors that have done it before, right? These are things that you can put effort into and due diligence into and really narrow the scope of variance. Okay. And then, like kind operation and expenses. So if I've got a 50 unit C class in Greensboro, there are probably 100 other 50 unit C classes in Greensboro. Maybe your property manager has experience here. Like there are people and other places you can go to understand today what is a like kind comp doing and form a really good basis for what a realistic state of your particular property either will be on day one or will be once you get it to a certain level. Okay, so that is not absolutely knowable, but is much more knowable than what I call the speculative list. These are things like exit cap rate. I mean, every kind of macro trend or high level financial input, cap rates, interest rates, things like that. People have been talking for years about interest rates spiking or this or that, and it's gone against almost every financial talking head on TV or economist that I've heard, right? There just are always shocks to the system, changes in geopolitical circumstances that can really affect these. So they are just, whereas a renovation budget is much more knowable, these are absolutely not knowable. They're completely speculative. If you get it right about what your exit cap rate is 6 years from now or 10 years from now, you got lucky. You may be right, but you got lucky. And that's not something that I want to rely on. It's not something I want my investors to rely on. So just wanted to give you an example of kind of what these kind of buckets are. So, and by the way, feel free to ask questions as we go through. Don't feel bad about interrupting. So what metrics can we utilize that stay within these parameters that focus on what is knowable and avoid what is speculation? So I want to propose 2 alternative deal measurements that I feel like satisfy these requirements. Okay. The first one is called unlevered yield on cost. It's also called return on cost. Those are the acronyms. I've seen yield on cost. It's got a couple different names. Unlevered yield on cost is the most accurate. It's also quite a mouthful. So I kind of use these terms interchangeably. And then the other one is your stabilized debt yield. A lot of times it's just called the debt yield. So I'm going to walk through these 2, which I want to propose as a far superior measure of a deal, both for operators and investors, than looking at the IRR. Okay. All right, Ashton, stay with me here. I know you're not a numbers guy, but it's going to get a little formula based.
I'm using smell installs. You're good.
I'm sure you have Solitaire on your computer, so you can you can relive your college days. All right, unlevered yield on cost or return on cost. This is my favorite metric. I feel like it encompasses and takes into account so much. I do a lot of value add. That's almost exclusively what I look at, what I own, what I'm interested in owning. So a lot of this comes from the value add mindset, but it's certainly applicable even for stabilized. It's just even simpler. But it's the best metric that kind of captures the totality of an investment. So the definition is your stabilized NOI. So if you got a value add, you project to be stabilized by year 3. What is your year 3 stabilized NOI divided by all the costs, your total acquisition costs, your purchase price, closing fees, And if you've got any renovation CapEx budget, which if it's value add, you will, that'll be actually a pretty big portion of it. That goes in the denominator as well. So the yield, it's what the property is earning when it's stabilized over how much capital it took to actually get it there. Okay. So you might be saying, wait a minute, is future NOI really knowable? Same thing with renovations. And again, we're not seeking absolute truth or anything absolutes, but we want something with very, very low variance. And I believe and have seen that, yes, a stabilized NOI is much more knowable because it's based on market comps that you do know today. Okay. So I'm not saying project what it'll be in 3 years. I'm saying if you snap your fingers, you are renovated to what your post-renovation state would be today, use market comps from today to understand what your rents are going to be and what the expense ratio is and other things for a property like that, right? You're basing that off of actual market data, again, and not guessing on something that's 7 years from now. So that matches my definition of something that is much more concrete and knowable in the near term. And same for renovations and whatnot. We talked about those as far as being knowable or not. Let's see. And additionally, there are a lot of these things like the renovations and the stabilized NOI. There's obviously lots of pieces that make up those numbers. So there's lots of inputs into those numbers, but a lot of them are under the operator's control. So again, we're still sticking within not relying on macro numbers, but numbers that I can control, right? So if renovations going in are not resulting the rents that we want, we can dial them back, right? That there are levers that we have access to as operators within these numbers that we can always be monitoring and making sure that we're kind of headed in the right point. Whereas if we throw our hands up and relying on a four exit cap 5 years from now, that's just wildly out of our control. Those are a much more reliable set of numbers to base analysis on. So let's look at a real example here. This is from a recent property that I was looking at. This was a pretty heavy value add. So year 3 NOI was going to be 1.725 million. Again, based on comparables post-reno state properties in this particular market. So feel very good about achievable rents, expense ratios, operating cost, all those things. Over what we know the total acquisition cost is going to be, right? Because we know what we're getting for our loan balance. We know how much CapEx budget we're raising. We know what the acquisition fees and everything are. We know what the total acquisition cost is before we close, but certainly on the day we close. So in this case, the total acquisition cost was going to be around 24 million. So that's a 7.18% return on cost. Okay. Looking at this, you may notice how similar the return on cost is to another metric that we talk a lot about in multifamily. What happens when I take out the kind of transaction and value add portions of this particular equation? So I went from this NOI over purchase price. That's your cap rate, right? So really the return on cost is just almost like a stabilized cap rate that takes into account the total costs and not just the purchase price, right? Because when you're doing value add, you have so much more than just the purchase price, where if it's stabilized, your cost is basically your purchase price plus some transaction fees, okay? So the yield on cost is just the cap rate plus taking into account the cost of the rehab and the transaction. To say another way, the difference between your return on cost and the market cap is your risk premium. Okay, so if my return on cost for my value add deal is calculated to be 7.18%, comparable at stabilized assets in that market, so a true comp, the market rate is a 5.5 cap. That's a 1.68, 168 bips delta between the two numbers. And that is basically your risk premium. That is the amount that you as the investor should get paid from this deal to take on the extra risk of that particular business plan. Okay.
You say, okay, so back up.
Yep.
How much are you saying you should make? The 168?
So I haven't said like what a good delta is.
Okay.
But because it's specific to the investor, right? So if I'm very comfortable with value add, and certainly if I'm the one operating it, I hopefully am very, very comfortable with it. But if you're investing in an operator and you're getting, call it 150 bips spread between your yield on cost and what a stabilized cap rate would be, you have to ask yourself, is that enough premium for me, the investor, taking on that risk? Maybe I know the operator really well. Maybe it's in my backyard. Maybe I've done a deal just like it and I know exactly what it can be. And so I'm very comfortable with 150 basis points being that delta. Maybe it's a super light value add, so I don't feel like there's much risk at all, and it's a great area. So even if we don't hit our rents, I know in 2 or 3 years this is a great area. It's Raleigh, Durham, it's Charlotte, it's Columbus or someplace in Florida or Texas, and 75 bips is all the premium I need. The point is that it's a really good way to extract a risk metric that you can evaluate for your own investment goals. Okay, so it specifically identifies that. And that tells you so much more than the IRR. That tells you exactly the return you're getting above and beyond kind of what a market rate type property is. So I have some targets that I know I look for when I'm underwriting. And these are generally, I'm not going to say agreed upon, but these are not far off from, I think, if you ask many other people. If anything, they might be a little high, like especially in this market, premiums have compressed a little bit. So anything where you're getting 100 bips over current cap rates for a similar asset post renovation, right? So yield on cost to stabilize to market cap is good. 150 bips is great. Okay, so if you're looking at a heavy value add and the return on cost, so say in a market it's a 6 cap market for stabilized stuff, your return on cost is like 6.5%. To me, it's a much clearer way to ask myself the question, is this enough return for this particular business model and business plan? It really kind of gets to the heart of the question.
And you're looking for a bigger spread, obviously. I mean, you said 150.
Bigger is more, right?
Yeah.
Yep.
Yeah.
Yep. It's what you are being paid to take on the risk as of the investment.
Yep. And then Ryan, do you mind answering a couple questions that are specific?
Absolutely.
To this?
Yeah, go ahead.
So David Holt's asking, as a passive investor, are these numbers, metrics usually provided? Or is that something that the passive investor has to do the math to see if the projections are realistic or not? Or is this mainly for active investors like the sponsor team?
I would love them to be for everybody, and I think they should be publicized. I think the reality is IRR is much more understandable. People are used to seeing it and talking about it. It's something that across asset classes can be used to compare. So I understand why it's out there. But as an investor, so internally, I would love all operators to use these numbers as sanity checks, this and then what I'm going to talk about, the debt yield. Yeah. But then as a passive investor, you from the OM, yeah, it's not a complicated calculation. From the OM, you should be able to have enough information to do this. I actually went through some of the OMs that I've reviewed recently from other operators and that I've invested in. And some I've had everything already, others did not. The ones that did not, what tended to be missing was the, well, actually, it relates more to the next number I'm talking about, the debt yield. The details of the loan sometimes weren't present to the level of detail that was necessary to do the debt yield. But the return on cost, usually by year 3 is when most people project to be stabilized. So you take your year 3, you go the pro forma of the OM, year 3 NOI, it's your top number. The purchase price from the OM. Usually they have a source of funds table that outlines the rest of the costs, and you can kind of sum up those costs. So I've never seen an OM that includes this already calculated for you, but it's a pretty easy get for yourself.
Oh, this is awesome, man. That's good stuff.
Any others? Or do you want me to go ahead?
Well, Chris is asking, I don't know if he's being smart, but where does one find the market cap rate? And I think that's probably good information for people that are not familiar with that, but where are you finding the market cap rate for your area?
Yep. So there is no one canonical source. I think the best thing to do, and if you're, I don't know if Chris is an operator, like operator mindset or investor mindset. If you're an investor, hopefully the OM has comparables, like comparable sales, and you can kind of deduce the cap rates of what at least the operator is telling you is a comparable property. And then on the operator side, hopefully between your own market knowledge and brokers, you can have it dialed in to a quarter of a percent, kind of what the prevailing cap rate is for that particular asset class.
Yeah, and then a couple other questions that I think they were answered in the chat actually, but so the basis points, what does that tell you? And if I understand correctly, it's telling you the spread in between, man, I need that graphic again, but it's telling you the spread, right? Between, yeah, there it is. So your yield to cash, market cap rate. Yep.
Yep, it's telling you the spread between the return that you expect to get based on your investment into this property that theoretically has some sort of value add component versus your much lower I mean, the market cap rate is basically the unlevered return, right? So it's the difference between the business model that you're buying into, the difference in return of the business model you're buying into with your investment in this property versus a generic market rate property that is already stabilized and you're not taking any risk or not trying to make any changes.
All right, cool. I think well, actually there's a bunch more popping up. Well, we'll get into those in a bit. We'll let you keep moving.
Okay.
Yeah.
And one thing I like to do, or one thing that this starts to help illuminate, this being the return on cost, we talked about the delta in premium between similar asset types, right? So in my market, my value add C class is this yield on cost, and I know a stabilized C class is this cap rate, comparing apples to apples. It's also useful to compare apples and pears, somewhat related, right? So if I look at a 7% yield on cost value add in a market I'm familiar with, and then I look at another investment like an A class, fully stabilized, brand new apartment property that I've seen come across my desk recently that's going for a 3.5 cap. I mean, the prevailing wisdom is that those are lower risk assets, right? A class, good metros, downtowns, great tenant bases, right? That theoretically, those are supposed to be much better assets, and thus you're getting a lower return. If that's a 3.5 cap, that's being purchased at a 3.5 cap, I can compare my 7% yield on cost with 3.5 cap. That's 350 bips of spread between these two assets, right? So it gives you a point of comparison even across asset classes. So then you can ask yourself, as an investor, do I feel like investing over here at a 7% yield and getting 3% more of unlevered return, which can be juiced with leverage, so we're taking financing out of this, over an A class in a downtown property? For me, I know I'm actually not that high on A class downtown properties, new build stuff. I mean, I think the pandemic showed nothing is completely risk-free. And when you're at a 3.5 cap, it's almost being priced as though it is risk-free. So for me, that is a sufficient premium to be like, yeah, I actually like the value add business model and the BC class better than the A. Somebody else might be like, no, 300 bips is not enough. You know, I need 400 or 500, whatever. So it's a good point of comparison even across asset classes. All right, so debt yield. So what doesn't the yield on cost take into account? I mentioned it, financing, right? It's looking at NOI, and it's looking at total acquisition costs. Financing isn't a part of that calculation, but obviously financing is a pretty big part of what we do in real estate. I mean, most of what we do is levered in some way, and it's usually by some sort of financing. The flip side of that is that aggressive or even just favorable financing can really obscure kind of the underlying quality of a deal. For instance, I've seen a deal recently that had 7 years of IO with like a 2.7% interest rate. Now, once I got over my extreme jealousy of the fact that I couldn't access that kind of financing, I realized it's not necessarily a good thing. Throughout the course of the ownership of that asset, it might be pretty good because you're juicing your cash on cash, and it lets you have access to assets that maybe you otherwise wouldn't have access to. But I would argue that this actually artificially inflates the returns and the value and adds risk by way of basically over leveraging your property, right? Leverage isn't just about LTV. There are many other ways that financing can be used that can over leverage a property, right? So think about if you are valuing the property based on its performance with this super low IO, super low interest rates and long IO periods, if you value it under those circumstances, well, how do you know that that type of super aggressive financing is going to be available to your next buyer, right? Times are going to change, right? One of the speculative things in my speculative bucket was like interest rates at some far in the future place, or even just the general financing environment. So when you have super beneficial financing now, and you're relying on that to make your numbers work, that's a risk. That is a point of leverage that you need to be really careful about. So, and it's very short-sighted to just value when so much of the juice is coming from your ability to get this type of financing. So we want a margin of safety, right? We want to know how much debt a deal can support that cuts through the noise of all these great terms that financing can have. So how do we cut through this obfuscation? My answer, and many people's answers, is not a new thing, right? This is a known ratio. It's called the stabilized debt yield. And once again, we'll recognize our top number being the stabilized NOI, which is same for return on cost. And now the denominator is basically your loan balance, but it's your total loan amount, right? Your outstanding loan balance. So what is this telling us? Okay, think about it from a lender's perspective. It's basically, it's a measure of the bank's return on that property if they had to take possession of it. Okay, or maybe the other way around, it's a measure of how quickly the property can pay off its own debt, right? If it didn't have to pay investors and everything else. So the bank took it over, say it got foreclosed on. Is this property yielding enough that it can repay and pay off the total loan balance in a reasonable amount of time? So it's really answering the question of how burdensome is the debt load to the property's earnings. So let's look at an example. And again, top and bottom are both knowable by my definition of much more knowable than anything that's in the speculative bucket. So in the same example we had, top number, stabilized NOI stays the same. The loan amount for this particular property that I was looking at would have been around 20.215. That's about an 8.5% debt yield. Okay. So what that says is if the bank had to take possession of it, they would be making 8.53% a year on this property that they now own. They're the lender. They don't need to worry about the debt service. This is what they're making. Also, if you kind of flip the calculation as far as 8.53%, if you do 100 divided by 8.53, it comes out to be 11.5 years. That's how long it would take to basically pay off the debt that was owed on it. So it's just the flip side of the same number, but think about it in terms of percentage. 8.53% is the return on this in the bank's eyes. And it's also useful to determine the ability to finance future loans, right? So if this number is too low, then it might be that you have access to favorable financing. If things change and your next buyer comes along and and you're kind of outside an acceptable range, it's a sign that it's financing. Like when a bank looks at this, when a new buyer's trying to get financing, the bank's going to look at this and be like, no, this property is not producing enough for me to write this loan on it. So you want to stay in a particular range here. And you notice that this calculation too, it cuts through a lot of the noise. So this calculation is independent of the amortization period. It's independent of the interest only period. It's independent of the interest rates, right? All those things, which are super favorable right now, it pushes those to the sides and it really cuts through the noise to get at what is kind of the debt load. But you're saying debt is useful, right? We use it to juice returns. And that's absolutely true, but it shouldn't put you in a bind, right? And that's the balance you're trying to make. You want to juice returns, but in a way that is within your risk profile, in a way that doesn't jeopardize the outcomes of the investment and of the property.
Is that different than the debt coverage ratio then?
Yes.
Okay.
Yes. So, yep, the debt coverage ratio is
the DCR, yeah.
The denominator for the DCR is your debt service, which does include and is impacted by, if it's interest only, the amortization period, and the interest rate, right? All those go into making that. So in the example that I had before, where the loan was 2.7%, IO for 7 years, 30-year AM, your DCR would probably show a good number, to show 1.3, 1.4, what we would all consider to be, a lot of buffer there. But it's because your interest rate is super low. You have IO, your amortization is as wide as it can be. Right. It tricks you into thinking there's enough there, and there may be enough there for your ownership period with your financing. But when you go to sell it or refi or other, the favorable terms may not be available to the next buyer, not necessarily because that next buyer doesn't have your qualifications, but because the economic environment has changed so much. So that's what the debt yield really cuts through and eliminates consideration of. Yeah. So as far as general targets, this can definitely fluctuate over time. Again, if you think about it as the bank's return on the property, if they had to take ownership of it, any bank looking at a 8% return right now is like, I'll do that all day long, right? I mean, yield is so elusive right now. Banks would love to get their hands on an 8.5% thing. In general, I think this is 2021, 8.5% or above, really solid. I think the historical kind of guidepost has been around 10%. So you want to stay 8.5 plus all the way up to 9 plus, 10 plus, right? That's your range and higher. It starts to get below 8. You maybe want to just put a little asterisk on that and really think about, okay, what is that appropriate for the time we're in, for the asset class, things like that. So those are the general boundaries of this target, and it does fluctuate a little bit, but it's still a very useful number and can be constructed with the stuff that on day one of ownership. So I want to end this with the whole point of the talk, which is not that IRR is useless and should be banned from every single OM that you as operators do and that you as investors are looking at, but just to recognize the flaws in numbers that are so dependent on far in the future, high leverage guesses. Cap rates, it's a guess. Exit cap is a guess. Interest rate environment, total guess, 5-7 plus years out, okay? Just recognize as those are super flawed projections, and instead understand risk metrics that are much more knowable and that can really be measured with what we can reasonably estimate based on stuff that is happening in this world today, okay? Whether it's market comps or known debt loads, things like that. There are metrics available that can kind of illuminate those deals. I think whenever we start to kind of, if we've been trained to look at IRR and expect a certain returns, it's really hard to kind of just throw that away and say, oh, now I'm looking at return on cost, and anything that's 700 bips and above for a value add is good by me. Like that can be a little uncomfortable. But I can definitely say, I think if you all, any operators on here or even investors, if you all go back and you look at deals that you've looked at, the ones that didn't meet the cut would have failed these metrics, and the ones that did would have looked pretty good on these two, right? So I think you can kind of do like a historical regression test and get comfortable with, okay, yes, these are in fact reliable, meaningful numbers. And I would argue actually expose a little bit more about the characteristics of that deal than if you were just looking at the IRR itself. So there it is. Ryan Daigle, Flywheel Equity. Love to have any questions or just talk shop. So don't be afraid to reach out.
Yeah, that's
What
good
other questions
stuff.
we have, Ashton?
That's good stuff, man. I think, and I think you hit right on the nose. Like the 15% IRR is waived in front of every deal I see these days. It's hilarious. And anything over that, they waive it even harder. So, but yeah, I wonder sometimes if people even understand what goes into the IRR. Like maybe if they understood better, like how we come to an IRR, an internal rate of return, maybe they'd understand why it's so flimsy, right? Because it's based off of like all you have right now, but you're looking 5, 7, maybe even further in the future, and that's what's making the average that 15%, right?
Yeah, and Rob Beardsley does a good job talking about this, the IRR partition, which is basically there's a way to calculate what percent of the total return, the IRR that is being projected, is due to the cash flows throughout the ownership period versus the appreciation that you get when you sell the asset and you have to wait a long time for, because it's acknowledging money up front that I can reasonably project in year one is a lot more reliable than an exit price in year 10. And so the IRR partition says, okay, well, in this deal, 70% of the projected returns are due to cash flow. Maybe that's considered to be more safe and less. Whereas maybe a value add deal, you flip that around and it's much more due to the appreciation. So there are ways to keep IRR around and further refine it and understand more about what goes into it. Because a lot of times, I think in general, 50-ish% is based on whatever that exit price is going to be. And that is reliant on so many super high leverage, really hard to know numbers.
Yeah. That's a good point. Okay, so a couple questions. So, and I hope I'm probably going to butcher this name. I apologize. Jagdish, he's asking, isn't calculating the stabilized NOI a function of project future income or projected future income, i.e. going back to the unknowables? And I'll let you expound on that. I think you covered a little bit, but maybe you could retouch on that.
Yeah, no, happy to do that. So again, I'm not talking, when I say knowable, I'm not talking absolutely knowable, just much more knowable and much more within my control as an operator than some macro number on some economist dashboard 5 to 7 years from now. So, and the reason I think it is more knowable is because you can really dial in an expected NOI based on market comps today. So I'm taking this property from point A to point B in 3 years, but I know I'm doing resurface countertops, I'm adding black appliances, I'm doing new LVP. Like I know all the things that I'm budgeting to put in. And I've got 5 to 6 other comps today that are in that state that are getting rents X, Y, and Z. That's my input, at least on the top line. I know a similar property. I know what it takes to operate it. My PM operates 5 others in the area, or I've gone out and I've done research and I know exactly what their expense ratio and operating expenses are. So will you ever reach perfection? Absolutely not. But you can be much more confident and come to a much more deterministic set of numbers that go into the NOI, projected NOI based on today. So that's the point I really want to get across. Like I'm really going out to the market today and getting known numbers that I expect to hit at that year 3 point.
Yeah, I think really the short and skinny, you're just looking at comps. Like you can look at, if you're looking at a 200 unit apartment complex with 2-bedroom, 1 bath, so you can look at other ones that have 2-bedroom, 1 bath in that same area, what they're renting for, what kind of amenities they have, what kind of finishes they have, right? And then you can kind of get a good idea. Yeah, that totally makes sense.
You have a lot more tools in your toolbox to narrow the variance of that projected NOI, whereas I have no tools in my toolbox to do anything about the cap rate 10 years from now. So that's the big difference.
Yeah. All right. So Cameron Brown's asking, NOI is also based on expenses. Should you also take into account that your potential buyer and or the bank may have higher expenses than you because they don't have access to some special advantage you might have, in parentheses, in-house property management, for example?
So I think there is a very few set of expenses that qualify under that special advantages, right? In-house property management absolutely would be one, right? If my business model is different from the markets, and that's how I differentiate myself, then I would never value my property based on my numbers and you see this a lot in OMs. I see, or just raw data that brokers send you. You see a lot of times where mom and pops are doing in-house management, and the underwriting, if it's coming through a broker, the broker will basically normalize those numbers to assume, whatever the 3-4% property management fee is for that type of property. So yes, I would not carry forward my competitive advantage to somebody else when I'm valuing the property.
Nice. And then Chris is asking, how do you underwrite debt yield before you have financing, or do you do that? I mean, are you talking to the bank ahead of time? Do you know you probably have a mortgage broker you lean on, I assume.
Yeah. I mean, depending on the deal, but I definitely feel much more comfortable getting a quote from a mortgage broker before I submit an LOI, so that is, it's one of the first things I would do when I'm getting serious about a property, is really understand the shape and the terms of the loan that it qualifies for, and to make sure that the bank is not looking at this with a different lens than I am. So yeah, that's something that would be done beforehand.
Yeah, I think that's a good point too, because when we started out, we leaned on our mortgage broker because he was telling us no so much. He would tell us it's a bad idea. And you're like, well, why are you saying that? Because we didn't know. We were figuring it out, right?
Yeah.
And yeah, he's like, I wouldn't do that. That's not a good projection there. And he actually taught us a lot. And that kind of goes without saying, like, it's an investment for the bank too, right? They're trying to cover their ass. They're usually more conservative than you are. So
they are the biggest investor in your deal,
right.
And they have also seen, probably by an order of magnitude, many more deals in that area than you have. So you absolutely need them on your team and need to be listening to them and their input.
That's not this. That's how 2008 ended up happening too. But you do have to double check each other, I'm sure. But they were helpful. They can be helpful.
Yep.
So, all right. So in an OM, Andy Bowman's asking, in the OM, would you consider the exit cap to be a good proxy for today's market cap? Andy, do you want to expound on that? Or
I think the whole basis of my talk was try not to even rely on any number that relies on the exit cap, which IRR is the main culprit. So, if I see an OM and it's 15% IRR and the exit cap has no spread on it from current market cap, then that's definitely a red flag. But I guarantee if I unwind that and look at my return on cost and debt yield, those numbers are also going to be flashing in the red. So I would say you shouldn't see the exact same exit cap assumption as what you're going in at. You should assume some expansion. But again, my preference is to not even have to rely on what your fudge factor is on a cap rate.
I think a follow-up to that is, are you developing your own underwriting tool, and can we have it?
I have definitely thought about it, not necessarily because of these metrics, but your underwriting tool is so specific to your particular workflow and what your personal preferences are and how you work, right? So there are lots of really good ones out there, but they all kind of irk me in some way because they don't work quite the way I want, or this number I have to go to another tab for when I just want it on the main page. So not yet, but I'm a nerd at heart. So when I get the need to scratch that itch, I may at some point. I've actually used a couple different ones. I think there's some good ones out there. Michael Blank's SDA is still pretty good. It's the one I'm most familiar with. I've tweaked it to include these numbers in kind of the summary view. So, above the IRR, investor returns, and cash on cash, I've got another section, which is like fundamental metrics, of which I include these DSCR, right, and some other ones. So, if you already have a model you're used to, it's pretty trivial to add these calculations. Again, they rely on information and cells that already exist in that model somewhere.
I'm just going to warn you, I need flashing lights though. So I'm going to need bright red.
I know you need
flashing.
colors. You need colors. You need pretty green and you need red, right?
Yeah. All right. So Jagdish has another questions here. So any thoughts on investing through platforms such as Fundrise versus dealing directly with relatively smaller operators who may be completely unknown to you as an investor? And I have a lot of opinions on this, but I'd love to hear yours.
I'll go first, and then you can tell me where I'm wrong. So, in general, I'm a fan of giving more people access to high quality real estate investments. That's what I want Flywheel Equity to help with, and so I believe that these platforms can serve a role. I've actually I forget how I've come across this. I've done some reading. I've in my course of talking to investors, have spoken to people who have invested in platforms like this. What you find, I think, in reality is that you now have another party between you and your end investment. There's somebody else, there's a middleman now between you and whoever your operator is. Now, if the platform itself were providing a service where they were identifying higher quality assets than you could normally get your hands on by way of being an individual investor, then I think that would be a valuable service that these platforms would provide. From what I've seen and heard, and even from their own published data, this does not appear to be the case. It seems like the types of investments that make it on are not high quality, have had a lot of issues. And so it tells me the platforms themselves are really not offering any higher level of service, and you're still getting the downside of now your direct line of communication between you and the operator has been severed, right? It's been obfuscated in some way. So I know as an investor myself, what I am selling is not just an investment, it's trust. And I would much rather have a direct line to my operator and know who they are as individuals, know what their group is about when I give money to somebody rather than a platform like that. So those are some of the pros and cons that I've observed and other people's experiences have been. I haven't personally used these platforms, but I know as an operator, I have to think about what is my differentiation from a platform like this. And I was quite honestly upfront kind of a little threatened by them, but the more I've heard about real world experiences, I'm like, okay, wow, they really do have some pretty sharp edges, and are not really providing the service that they say that they are. So I don't know, Ashton, if your experiences have been different, but go ahead.
Yeah, I mean, I should probably caveat that I haven't invested in any of these, but just by dealing with other people that have come by different viewpoints and then things I've read. But excuse me, I think it comes back to what your goals are. I think the price point to invest in some of these is a lot lower, so it might be more appealing to people. But what I've seen, and I'm not sure about Fundrise in particular, but I know a lot of them, you don't get the pass-through benefits of being a limited partner because you're not exactly a partner on these deals. It's more of you're investing in a fund that's diversified across a bunch of different deals, right? Is how I understand it. But with when you go to a syndication team, they're putting together an LLC, and when they bring in passive investors, those passive investors become limited partners, and that LLC becomes a pass-through entity. And so all the benefits of owning real estate pass through to all the investors, all the partners. So you get all those tax deductions, you get, and of course, a lot of it goes back to what you're saying too. You get to know, like, and trust the people you're working with. And I think that's a huge part of what that's why I buy the toothpaste I buy, because I trust them. Obviously we're promoting our business here just by having this meetup. But I mean, the reality is, like, that's what it comes down to. If you trust Fundrise, then go for it. If it makes more sense for you, then absolutely. But I think when you look at the benefits, the pass-through benefits of being a partnership of a smaller entity like that, I think it's a little bit better personally. But Everybody's got their
Yeah, I
own
mean,
goals.
I would say do some research. Like there have been platforms, like Fundrise that have gone belly up, and so they present kind of a compelling opportunity and pitch, but I've been a little disappointed in the level of professionalism that they're providing and the value over just going direct to an operator. So just know what you're getting into and what the trade-offs are.
Yeah, I think that's a good answer. All right. So last question we got on here is from Steven Munoz. What are your assumptions when it comes to vacancy rate for a stabilized NOI?
It depends wholly on the type of asset, the metro, et cetera, et cetera. For higher class stuff in great areas, all this stuff is publicly available, right? So down to the metro, down to the class, Yardi, RealPage, Marcus and Millichap, they all release metro specific kind of historical summaries and quarterly updates. So, if you're looking at an OM and you see a 4% physical vacancy assumption and 1% for economic vacancies for 5% total, you can go back and look at, for whatever class of asset that is in that market, to see what a realistic historical average has been, and then decide if you think that's aggressive or if you want to tweak it, right? Are they going based on a 20-year average, or do they take the last 5 years, which has been really good? So that is definitely something that you can look up yourself. I think, like, for the type of stuff that I do, with C class, clean, safe workforce, but affordable workforce housing, physical vacancies tend to be much lower. So you can get occupancy levels of 95, 96%, depending on the area. But you have to watch out for it, because your economic vacancies might be a little higher, right? Delinquencies, bad debts, things like that are going to run a little bit higher. So I tend to like totals being no less than 7 or 8% across the two. But if I saw an A-class deal in a really strong area and it was 6.5 total, and it was within a kind of normal historical range, I wouldn't necessarily feel like that was an operator being overly aggressive.
Good answer. And I think, if you look at what like Freddie Mac and Fannie Mae are loaning on, I think their restrictions are, Chris, correct me if I'm wrong, but the last one we did, they want to see 92%, right? Occupancy. So they wouldn't even loan on something like that right off the bat. So unless you're going to do an all cash offer, good luck, or maybe bring more to the table. I don't know.
Yeah, we even had a dip right before the purchase in September of 2020. And so they had to wait till they got October numbers just to prove that the occupancy wasn't below 92.
Yeah. So otherwise we couldn't close. So it didn't even matter what our numbers said on our spreadsheet. We couldn't even close on the deal. So, but all right.
Yep.
But yeah, unless you guys have anything else, Chris, we'll turn it over to you. We can jump into, or Ryan, like, do you have anything else you want to add to this? I think that was an awesome presentation, man. I think a lot of those numbers, like, people overlook it. I know I do. There's a few numbers I zero in on that I think are really important. And then I like to, reiterate those when I'm looking at a deal. But I think you illuminate a lot of holes in some of those analysis. So.
You can only look at so many numbers before you get overwhelmed and it starts to be not useful, right? So I just want to try and make the case to avert your eyes from the IRR next time and maybe go towards these alternatives as another option.
I think that was good. Yeah.